soaring inflation has added new terms to the common lexicon this year. The most famous is shrinkflation, where a 155-gram bar of dishwashing soap of 10 rupees starts weighing 140 grams for the same price. This means that the cost of making that soap has gone up, but the company doesn't want to pass that burden on to buyers, especially if they belong to the bottom of the wealth pyramid. Or downtrading, where buyers switch from an expensive or bigger product to a smaller or lower end one. For example, those using a Pear's soap may have switched to Lux. The increasing frequency with which these terms have been appearing in the news points to the nature of the Indian economy's recovery. Let us look at the latest data. Makers of consumer electronics like smartphones, televisions, and other appliances have reportedly slashed production by almost a third since the beginning of November compared with a year earlier. This is the second time this year that firms have cut production. While smartphone sales were down year on year by over a third in November, the entry-level segment witnessed a sharper fall with half of its sales wiped out. This is what market researcher Counterpoint told the media. A well-known maker of consumer electronics told one financial daily that in televisions, the entry-level segment was the worst hit. The 32-inch variant had accounted for half of the total television sales last year, but its contribution is now down to just above a third. Sales of entry-level products had reportedly remained muted even during the festival season. Industry members told the media that while demand becomes muted after Diwali every year, this year was proving to be the worst in about a decade.
Due to macroeconomic headwinds and due to inflationary pressures, right, the sub 10,000 segment has been hit the worst. So consumers in that particular segment have been postponing their discretionary purchases, which includes electronics as well as smartphones. So when we went into the festive season this year, the smartphone inventory was at around 10 weeks, which was way higher than the normal average inventory. Now, even after the festive season sales with the aggressive offers, the inventory has not come down yet. It's still at around 8 to 9 weeks, which is high. So brands in all will look to clear that inventory in the channel first before kind of filling channel with new shipments, and combine it with the fact that the demand in itself does not look very optimistic, especially in the lower price tiers. This is bound to affect shipments as well as production.
After the release of data on India's September factory output, as measured by the Index of Industrial Production, economists had told the media that the poor performance of both consumer durables and non-durables was worrisome. Consumer durables include cars and household appliances that typically have a long useful life, and items that are consumed in one use or a few uses are called non-durables. Contrary to the growth typically seen ahead of the festival months, consumer durables output contracted 4.5% in September after falling 2.5% in August. Within the sector, sales of entry-level appliances and goods were muted even during the festival season. This could mean that rural India continues to be under stress. Meanwhile, sales of mid and high-end products reportedly jumped over a quarter during Diwali. The fast-moving consumer goods market reportedly fell 15% by value in November compared to October. Why? Because Kirana stores cut down on purchases. After aggressively restocking their shelves in the build-up to the festival season, most retailers still had leftover inventory. One industry executive had some good news. Volume growth was recovering gradually, with inflation having peaked. But he cautioned that the pickup in demand was still slow in rural India. Rural consumption in India has remained under stress, with volumes of FMCG firms declining in both the July-September and the April-June quarters. In an indication of how concerned India Inc. is, in the lead-up to the budget, the country's top business leaders and industry bodies have asked Finance Minister Nirmala Sitharaman to rationalize personal tax rates, especially at the lower end of the income spectrum. They hope that such a move will increase broad-based consumption. Meanwhile, the relatively affluent remain untouched by sticky inflation. For example, this was the best November ever for car makers. It was also the 6th straight month when domestic car sales zipped past 300,000 units. According to one executive, the industry was well on its way to breach the previous sales record of calendar year 2018. Meanwhile, retail loans expanded by 20% in October, against just below 13% a year ago. The rise in credit offtake was largely driven by the housing and vehicle loan segments. Clearly, the Indian economy's recovery from the effects of the COVID-19 pandemic remains K-shaped, which means that while those towards the top of the wealth pyramid have continued buying goods and services, even increasing their consumption, those at the bottom have seen their discretionary income shrink. Discretionary income is the money a household or individual has left to spend after necessities are paid for. So, how will such a prolonged spell of K-shaped recovery impact the economy?
See, a K-shaped recovery, which we're seeing today for a longer period of time, actually indicates that we cannot be certain about the growth path. So growth is going to be a bit volatile. I mean, at times we'll be seeing that quarterly numbers show an upside, otherwise there'll be a downside, because growth is not broad-based. And numerically, we will probably still be in the region of around 6.5% next year, and maybe a little higher the following year. But it won't be a case of saying that the manufacturing sector in particular will be showing robust growth. It would still be very much uneven with the infrastructure or the metals kind of segments. Those are the ones which would probably be driving, those which are linked more to what the government is doing on the infrastructure side.
And when can we expect the recovery to become more inclusive?
So it will take a much longer time for it to become broad-based, because the way in which economies progress is that growth starts from the consumption-based sectors and then moves over to the infrastructure, the investment-based sectors. Now, given the fact that consumption has been lagging, and this has been a problem even before COVID, so I would tend to believe that this will take a longer period of time before we're able to create jobs, generate income, which leads to higher consumption. So therefore, it could be another 2-3 years before it becomes really broad-based.
This raises an important question. How long can India afford having its population split in two? Those that have moved on from the pandemic's impact and those that are still struggling to recover.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.